Hello, and welcome back to, I believe this will be our final Camtasia video lecture dealing with Chapter 5, which is CVP analysis. In this video, we're going to look at three things, really. We're going to look, or four things, excuse me. We're going to look at margin of safety. So you should be able to compute margin of safety and explain why it's significant. We're going to look at cost structure and profitability. We're going to look at the degree of operating leverage. So after this video, you should be able to compute the degree of operating leverage at a particular level of sales. In addition, you should be able to explain how the degree of operating leverage can be used to predict changes in net operating income. And we're going to talk about structuring sales commission, as well as get an understanding of this idea of sales mix. So what is the margin of safety? Well, before we even dive into it, it's important to realize what exactly margin of safety is, okay? And basically, when we're talking about the margin of safety, it's the excess of budgeted or actual sales dollars over the break-even volume of sales dollars, okay? So we're looking at what's our break-even volume in sales dollars versus what's our actual sales, or we could use budgeted sales, but in this case, we'll use actual sales, okay? Again, this is the amount by which sales can drop before losses are incurred. So, since it's the amount that sales can drop before we start incurring losses, obviously, the higher the margin of safety, the lower the risk of not breaking even, or the lower of risk of incurring a loss. Okay, we see how to calculate margin of safety right here on the slide. Right, margin of safety in dollars equals total sales dollars minus the break-even point in sales dollars. So let's look at an example. Okay, let's assume here for a moment that RBC has actual sales of $250,000. We already know the break-even point in sales, right? The break-even point is $200,000. So that means that the margin of safety is $50,000. Now, the key thing here is that the margin of safety, we can look at it in dollars, which we just did. We're going to see how to do it, or we're going to see how we look at the margin of safety in terms of a percentage. And we're also going to be able to, or we're also going to see how we can express margin of safety in terms of the number of units sold. Okay? So let's look at it as a percentage. RBC, the margin of safety, we can express this as 20%. How did we get that? Very simply, we took the margin of safety in sales dollars, $50,000, and divided it by the total sales, $250,000. Again, we say that, okay, sales can drop by 20% before we're either going to break even or we're going to incur a loss, okay? We can also express margin of safety in terms of the number of units sold. How do we do that? Very simply. Margin of safety in units is the margin of safety in dollars, 50,000, this time divided by the unit selling price. It gives us 100 bikes. Again, what's that mean? What's the margin of safety in units mean to us? Well, RBC sales, or their bicycle sales, can drop by 100 bikes before they're in danger of either breaking even or incurring a loss. Now let's look at cost structure. What do we mean by cost structure? Well, cost structure refers to the relative proportion of fixed and variable costs in an organization. What the hell does that mean, right? Think about it. Cost structure says, what's the proportion of variable expenses to fixed expenses? Do I have a lot of fixed expenses and low variable expenses? Or am I the total opposite? Do I have high variable expenses and low fixed expenses? Now, managers often have some latitude in determining their organization's cost structure. So it's important that we understand the advantages and disadvantages of the various proportions of variable to fixed expenses that we maybe choose to have or that we actually incur. So there are advantages and disadvantages to, let's just look at high fixed costs first, right? Or conversely, we can say low variable. We either have high fixed or low variable, right? Or we can have low fixed costs and high variable, okay? So it can go either way. Now, there is an advantage of having high fixed cost structure, meaning we have more, our fixed costs are higher than our variable costs, right? What's the advantage of that? Well, the advantage of a higher fixed cost structure is that income will be higher in good years compared to companies with lower portions of fixed costs. That makes sense. That makes 100% of sense. Why? Think about it. Fixed costs never, ever change, right? Again, as long as we're within the relevant range. Variable costs change in direct proportion to changes in levels of activity. So, in times or in years when sales are good, right? Our sales are going to be high. As a result, our variable costs are going to be high. That's going to make our contribution margin lower. Now, the good news is we have lower fixed costs to cover, okay? However, if we have a high cost structure, when sales are good, our variable costs, since the variable cost per unit, since we have a lower proportion of variable cost to fixed, that means the total variable costs will be lower than our fixed expense. So our contribution margin will be higher. We have more fixed costs to cover, but that's okay because sales are good. What's a disadvantage? Well, a disadvantage of high fixed cost structure is that the income is actually going to be lower in bad years compared to companies with a lower portion of fixed costs. What's that mean? Well, think about it. Years are bad, right? We're going to have lower total variable costs. Why? Because our cost structure says that our fixed costs are higher. So we're going to have a lower contribution margin when sales are in bad years, when sales are down. That means we have this huge hurdle to overcome. That hurdle is that larger fixed expenses, okay? Now, companies with a low fixed cost structure enjoy greater stability in income across good and bad years. So if we're looking for continuity, if we have a cost structure that are lower fixed, we're going to have stability in income across the good and bad years. Now let's look at the degree of operating leverage. Let's define what it is and let's see how we calculate that. So what exactly is the operating leverage? Well, operating leverage is a measure of how sensitive net operating income is to percentage changes in sales. So what it allows us to do or allows us to see is, okay, I'm going to have a percentage change in sales, right? The economy's going to go up, going to go down, sales are going to be good, they're going to be not so good. What operating leverage or degree of operating leverage really does is it allows us to see how sensitive that net operating income change is, okay? So the degree of operating leverage, again, is a measure, we can do it at any given sales, of how a percentage change in sales volume will affect the bottom line. We see here on the slide how to compute it. Contribution margin divided by net operating income provides us with the degree of operating leverage. Let's look at an example here of how RBC or how sensitive RBC's net income is by utilizing this degree of operating leverage. So the first thing we have here is obviously contribution formatted income statement. And we can see, just based on this, that RBC's degree of operating leverage is 5. Okay? Right off the bat, that really means nothing to us. But we see how to calculate it. Contribution margin of 100,000 divided by 20,000 gives us 5. We're not done yet, right? What we need to do is we need to see how that operating leverage of 5 affects RBC's bottom line when sales change, okay? So let's look at it this way. We have an operating leverage of 5. If RBC's sales increase by 10%, net operating income would increase by 50%, right? So we could say it's very, very, very sensitive, right? That net operating income is very sensitive to changes in levels of activity, okay? So let's look for the proof. Where's the proof, right? Well, very simply, all we need to do is look at the contribution formatted income statement, right? Sales increased by 10%. So instead of selling 500 bikes, we're going to sell 550. We're going to run the contribution formatted income statement, and we're going to see that a 10% increase in sales from $250,000 to $275,000 results in a 50% increase in income. How do we get that? Well, look, we had 20%, or I'm sorry, we had $20,000 in net operating income. Because sales went up 10%, our new net operating income is $30,000. That's a 50% increase. It's important to realize here too that when we're talking about operating leverage, it's important here that you understand that the degree of operating leverage, it's not constant like variable cost per unit or contribution margin per unit that a manager actually can apply with confidence in varying situations, right? So the degree of operating leverage is always going to change. The degree of operating leverage is dependent on the level of sales, and we're going to constantly be computing the degree of operating leverage each time our sales levels change, okay? Remember, operating leverage is the greatest at sales levels near the break-even point, and it decreases as sales and profits rise. Okay, so as our profits rise, as our sales, comparing it with the break-even point, sales that are at or near the break-even point, our operating leverage increases, okay? It decreases, meaning that operating leverage decreases as sales and profits rise. So as we get further away from the break-even point, our degree of operating leverage shrinks, okay? We'll look at examples of how to calculate this when we go through our exercises in the study guide. So let's talk about structuring sales commission first. So I think we're all kind of familiar with the idea of commissions, right? Companies generally compensate their salespeople by paying them either a commission that's going to be based on their sales, or a salary plus a sales commission, right? It's important here that we realize that commissions based on sales dollars can actually lead to lower profits in a company. Let's look at an example of this, okay? Because that's kind of interesting, right? Because we saw an example of we're increasing variable costs here, right? And potentially either keeping our fixed costs the same or getting rid of them. But in this example, if we have salary plus commission, fixed costs are going to remain the same, our variable costs are going to go up. But let's look at an example here. So let's say Pipeline Unlimited produces two types of surfboards, the XR7 and the Turbo. The XR7 sells for $100, generates a contribution margin per unit of $25. The Turbo sells for $150 and earns a contribution margin per unit of $18. Okay, so let's look at the sales force at Pipeline Unlimited when they're compensated based on sales commission. Okay, and we're going to look at the difference between these two boards. So to eliminate any conflict, right? Commission can be based on contribution margin rather than sales price alone. Okay, why would we do that? Well, think about it. If we base sales commission on the number of units we sell, what's going to happen here? Okay, let's focus on that. We are all salespeople. Okay, which board are we going to sell? Which board are we going to attempt to sell the most at, or the most of? Right? A customer comes into our company or comes into our showroom, and they say, "Hey, I'm here for a surfboard." Right? And Ronnie, because I know Ronnie's either fast forwarding through the video or not paying attention. And I did say last week I was going to pick on Ronnie, so it's a little late, but here it comes. So me and Ronnie are salespeople, right? And let's say that customer comes in. Two customers come in, right? Me and Ronnie each get a customer, and me and Ronnie have a decision to make. This customer wants a surfboard. Well, we're going to take them to the Turbo. Hands down, we're taking them to the Turbo. You need to buy this Turbo surfboard. It's amazing. Why? Well, think about the unit selling price. The XR7 only gives me $100 of sales. So I'm going to get commission of $100, right? If I sell the Turbo costs $150. That's a higher selling point. Guess what? I'm going to get a higher commission. Okay? Now let's look at it from the company perspective. Which one does the company want to sell the most of? Well, the company wants to sell more XR7s than Turbos. And you might be thinking, well, why? Why would the company want to sell more of a board that costs less compared to a board that sells for a higher selling price, right? Well, the reason why is because I'm the company. I don't care about selling price. I mean, I do, but I know that that the more I sell, the higher my variable costs are going to be, right? The lower my contribution margin is. This problem, the way they set it up, already said, hey, your contribution margin per unit is $25. So each board that I sell, I have $25 to go to fixed costs and provide me for a net operating income. If I sell the Turbo, I'm making $150 sell, right? But that's only providing me with a contribution margin per unit of $18 to go to cover fixed costs and provide a net operating income. So as the company, I get more bang for my buck, meaning my contribution margin is higher for the cheaper board, the XR7, okay? So I'm losing money as a company. If I base commission on sales, I'm losing money. Why? Because my salespeople are going to go out and they're not going to push the XR7 because they're making less money as compared to selling a Turbo board that costs $150, right? They're making more money. Their variable costs are going up, right? Or the variable costs are going up. My contribution margin, the contribution margin that I'm applying to that bottom line is only $18. That doesn't help me. I mean, it does, but the $25 board, or the board that provides the $25 contribution margin, really helps the company. Okay, so that's why we're saying that even though Salesforce at Pipeline, they're going to push that Turbo board, right? Even though the XR7 earns a higher contribution margin per unit. So if we want to get rid of any conflict, we're going to base commission on the contribution margin rather than the selling price alone. Okay, so let's look at break-even point in a multiple product company, right? And explain how shifts in the sales mix affect the contribution margin as well as the break-even point, okay? Keep in mind here, this is kind of like a little disclaimer, that these calculations that we're going to be doing assume a constant sales mix, meaning there's going to be a ratio, or we're going to have a ratio assumption. Okay, and and basically what we're saying is, for every every 2 pens we sell 1 pencil. Okay, so there's that constant sales mix. Now the rationale for this assumption looks like this, right? To use a simple break-even and target profit formulas, we have to assume that the firm has a single product, right? So we do just that, right? Even in multiple product companies, we assume that there's a ratio, okay? So the trick is to assume that the company is really selling baskets of products, and each basket always contains the various products in the same proportion, okay? So let's look at this here. Let's assume for a moment that RBC sells bikes and carts, right? The bikes comprise 45% of the company's total sales revenue. The carts comprise the remaining 55%. So the contribution margin ratio for both products combined is 48.2%. Okay, so basically what we need to do here is calculate the ratios for each cart and bike. Okay, and basically to figure out the total, what we do is we work from our total column. The total sales from bikes and carts is $550,000, right? The total contribution margin between bikes and carts is $265 or $265,000. So what we do is, based on the total of that basket of bikes and carts that are sold, we take the total contribution margin and divide it by the total sales. We get 48.2%. Okay, so we're still using the same concepts. We're just adding the two concepts. We're taking that concept and we're applying it to 2 products, and then we're adding up the totals. Okay, dollar sales to break even point, very easy. Fixed expenses divided by the CM ratio, right? We're using the total column. So we're taking our $170,000 of fixed expenses divided by the total CM ratio. We get our $352,697. That is the dollar sales to break even. Notice here that net operating income is actually not zero, it's $176. Because we're getting a little bit more complex and we're trying to take this complex situation, apply some easy assumptions. That easy assumption is the sales mix. It's in a constant proportion to each other. It's a rounding error, okay? So we're okay with the fact that we have $176 net operating income. Again, why? Due to a rounding error. Well, my friends, that is Chapter 5 in a nutshell. When we come back, what we are going to do is we are going to go over the exercises that we have in our study guide. I would encourage you to attempt those on your own first, right? You read the chapter, you watched the lecture videos, you took notes, I'm hoping. Just try it. I know it might be a little confusing, that's okay. The only way to learn this is to mess up, or the only way to learn this is to work with the material, mess up, identify why you messed up, and that's how you learn, okay? So, tune back in where we'll cover our study guide exercises. Thanks for tuning in, and we'll see you again.